Hey there, I'm Pete Townsend, and this is Money Never Sleeps. We look inside the minds of entrepreneurs and at the crossover of startups, enterprise, finance, technology, and life as we know it. In this episode, I'm joined by guest co-host Gray Webb. Gray Webb is an entrepreneur and technology professional specializing in digital asset and equity capital markets. With over 20 years of experience, he has expertise in high-frequency trading, risk management, and post-trade systems. He's currently the co-founder and CTO of Liquibit Capital, an algorithmic-driven trading and asset management company. Gray is also involved in mentoring, teaching, and startup mentoring in the blockchain and Web3 space, and is one of the fantastic mentors for founders in the Techstars Web3 accelerator program. He has a strong background in product management and technology delivery, having worked with companies like Digital Asset and JPMorgan in the past. In this Money Talk segment, Gray and I kick things off with an update on Liquibit Capital to bring us all up to speed since we recorded episode 138 way back in 2021 with Gray and his co-founder Joseph Chang, before we look at what's happened since the latest Bitcoin halving. Gray and I then riff on the evolution of Bitcoin from where it all started into where it could all go from here as a long-term holding with huge opportunities for financial innovation. We then close things out with a look at the mainstreaming of stablecoins as a killer app for crypto. All right here on Money Never Sleeps. Gray Webb, how you doing?
Hey Pete, good afternoon, good morning.
Good afternoon. No, it is morning, isn't it? It's morning for both of us this time. The last time that we talked on the podcast, it would have been late night for you in Hong Kong, but now you're in a different part of the world, aren't you?
Yeah, we're in the French Alps, being very fortunate to be here. I had a great ski season actually. Just coming to an end a couple of weeks ago. Epic April. April always seems to deliver in terms of snow.
That's crazy.
Yeah, it's been fantastic actually. And the slopes are quiet because everyone goes away and thinks the ski season's over. Everyone else seems to we have the slopes to ourselves. So it's been a good end to the season. Apart from what we do for our day job, skiing is my number one passion.
Very good. Very good. And this is reminiscent of the ChatGPT bio that we had written for you as part of your role as a mentor for Techstars Web3. And that the last sentence that it came up with was, outside of work, Gray enjoys skiing, running, golf, cycling, and photography.
This is true. And yeah, here's a great spot to do, particularly the skiing and the cycling part.
Wonderful.
Yeah, so my thoughts are turning towards the road cycling. And in fact, I've got a bike race this weekend in England for motor neurone disease. A school friend of ours, sadly, has been recently diagnosed with MND. So a few of us are getting together to cycle around my old stomping ground in Kent. We raise a few pounds for awareness around MND. So yeah, cycling season is well and truly up and running as well.
It's great motivation for pedaling hard, right? They say it never gets any easier. You just pedal faster.
Yeah, it's all upstairs. That's what I love about cycling. It's that mental hard things when it comes to building businesses. There's hard things when it comes to riding a bike up a hill. There's a lot of analogies there, I think, in terms of the mental strength you need to get through the bits when everything else is just saying, there's got to be I could just do something way easier than this, but reward at the top. It's definitely the thing to be striving for. And if you can get through your brain saying, just stop, then the rewards are there. So, yeah, I like that analogy. I like that analogy of cycling. And I think that's one of the reasons road cyclists love it. It's the pain of getting up to the top to enjoy the descent down.
Totally. And I have similar feeling for my alpine climbing days. It was like, Jesus, this is a 4-hour slog up. But you know what? It's a 45-minute just stomp down. And you know it's the bottom of the hill, like this Burger Hut. And we're just going to go for it.
Yeah.
So it was all good stuff. Speaking of cycles, right? We're on a cycle right now, a newish cycle with Bitcoin. And there's also been what was it? It was 2021 when I first spoke with you and Joseph from Liquibit about the business. And I wanted to cover a couple of things with you today, but first wanted to hear the story about where you guys are with Liquibit right now and how things are looking.
Yeah, well, I think, first of all, still here. We're sort of into our sort of third growth cycle now. We launched Liquibit Capital. We're a digital asset manager. We launched in June 2020, and we're in our third growth cycle now. We've been through a couple of bear markets, and we're still pumping out the returns for our investors. The footprint of which is sort of it's grown, it's shrunk. And we're currently in a cycle where it's growing again, pleased to say. And I think a lot of that is our established track record. We're nearly 4 years now on the track. Through the tough times of winters, which are well documented, we've been able to sustain some level of decent return for our investors and continue to invest in our tech platform. We've had the growing pains, of course, associated with any sort of startup business in a nascent industry, both ourselves and obviously with all the counterparties that you deal with in crypto. We're not the only, everyone is new to this still to some extent, and both the exchanges we trade with, they're going through learning, and we are as well. But yet, generally speaking, we're very positive at the moment at Liquibit with the future. And I think, with this growth cycle, what we're seeing from the investors who are with us, our investor base is increasingly fund of funds, institutional level, people investing money, and well-recognized fund of funds who are coming in and looking for, understanding the risk-reward profile of the asset class. I suppose previous cycles have been somewhat more crypto. Okay, here's a way to make a quick buck. People are looking sort of at a 5, 10, 100x strategies where punts and meme coins. Maybe then a bit more sophistication on the sort of the VC angle, picking the right projects, trying to get in on seed rounds on tokens early. Get in and shift those on later on. Our strategy is market neutral arbitrage, Delta One product.
And it's been impressive. I'm reading your fact sheet, your newsletter every month, seeing the numbers you guys keep pumping out. And that's, I think, one of the biggest things with it is with just understanding market neutral arbitrage and understanding that regardless of which way the markets are going directionally, that there is always an opportunity to benefit off of the ups and downs, the volatility. And it's been impressive to see that consistency over the last few years. And when you and I started talking, Gray, this was after the last halving, okay? And that back in 2020, where our friend Barry Skinner, shout out to Barry, or Crypto Baz, as he's known in some circles, he and I just started vibing on, hey, what do we think is going to happen with Bitcoin? Because I told him about blockchain back, 2016, 2017, 2018. He started messing around with crypto a bit. And he started just telling me, listen, there are these other people in the circle here who I think you might get along with. And that's when he introduced us. And it would have been probably around about late 2020, early 2021. So it's amazing. We're now on this cycle of the next halving behind us. And it kind of went over like, I'm almost happy that it went through without any big, huge noise around the market price of Bitcoin, that it was relatively flat around the edges. It was before we had the big run up, but then during and since now. But I think there's some other market factors at play that are going to unfold here. Any perspectives from you on this?
Typically with the halvings, we've seen it before. There's the run up beforehand, which I think we've had this cycle. If you look at anything from sort of November, December last year onwards, it's been one way direction. We've had the halving now. We expect traditionally, that there's a little bit of a cooling off in this sort of middle period. I think, around the halving itself, obviously the price action was relatively mild. And perhaps there's going to be some level of cooling off. There's obviously more macro factors affecting risk off of assets across the market. Ultimately, the rate of supply has decreased, and that should probably reflect itself in the price. And the typical behavior is obviously that the price continues to appreciate once we're sort of through this middle period of adjustment post-halving. So I guess to some extent, I think we're seeing it as fairly typical. And I think, obviously with the demand, the underlying demand for the asset class to support the regulated products, there's a lot more to come there. There's a lot of activity, as you know, Pete, behind the scenes. The wealth management industry, how long it takes to get the mandates updated, things like that in terms of this asset class for some of the more traditional, well-established wealth managers. And everyone's looking at it now because the regulated products are there. But those mandates to do these activities won't come immediately. So there's going to be this sort of backlog of mandate updates, etc., as more and more, I'd say, very well recognized, long-standing institutional wealth managers start to add this asset class to their product set. That's just going to provide the support and the floor for this asset class going forward, well beyond this halving and any other sort of technical supply level type stuff. So
Yeah, I'm very, call it excited, call it what you want, about the wealth managers starting to actively solicit purchases of Bitcoin ETFs, right? And that to actively sell these products of these big asset managers that are now running. And I think I had shared with you, Blockworks have a pretty good BTC ETF tracker, right?
That's a great one pager.
But just seeing some of the numbers here, obviously Grayscale, we always known was at the top. Obviously, they've come down big time, now down to 36 billion. But BlackRock at 16 billion in market cap on their spot Bitcoin ETF. Fidelity coming up at nearly 9.9 billion in assets under management. ARC21 shares at 2.8, Bitwise at 2.1, ProShares at then dropping down to 600 million. It's like, wow, that's a lot of money came into the space pretty quickly with a total market cap of nearing 72 billion that came in. So, and that's since January that all this has come in. And this has been on the basis of asset managers launching products that people say, hey, I want to buy that, rather than wealth managers who have associations with these asset managers being incentivized to sell these products. They can't be incentivized to sell these products with trailer fees and things like that until it's gone through all the due diligence, until it's got a bit of a track record. These things take 3 to 6 to 9 months to get into place. And that's when the next cycle will hit. And what I'm really more interested in is, as you mentioned, the floors, right? What are we going to see as the floors and the price resistance of Bitcoin in the market? And, tons of people that I've talked to have speculated on this. And obviously none of this is investment advice, but I'm excited for this kind of resistance level in the next one that we'll have beyond what feels like about 60K and where it's going to go from here.
Well, I mean, the last bear market, that we didn't, the predictions were going down to 11, 12, and we were 20% off that at least. So it was above even where people thought it might go down. Yeah, where the floor remains for where the new floor is post the regulated products and the bigger wealth managers coming in. You don't hear it so much anymore, and maybe because it's you and I are in it the whole time. But the whole get off zero thing is still valid, right? It's almost even more valid now, as you've got some of these more regulated products out there for any investor in any sort of portfolio they might be holding. Again, not investment advice, but that get off zero thing is definitely a theme that still exists. It hasn't gone anywhere. And there's now ways to do that in a way that the large institutions can be comfortable with, their risk committees can be comfortable with, and is executable, importantly, at size. Right? Liquidity, in terms of liquidity and the provision thereof, slowly starting to increase. So, it's all very well wanting to do something, but obviously you've got to be able to go into the market and actually execute.
Yep. And it's like when the ETFs enter into this mode of being a risk on, risk off asset, and the 4 professional, call them asset managers, call them wealth managers, professional traders, whatever you want to call them, and that where there's tons more kind of quantitative analysis done by the traditional finance markets on what these Bitcoin ETFs are doing, what the price of Bitcoin is doing, basically moving up and down, and where you have people that are looking at these markets on a broader basis, a lot more traders than had been in the past, because they can get in and they can get access through the ETF, whereas perhaps there had been some restrictions around that before about what they could and could not buy as a digital asset, as crypto. And they're saying, when we see this price dip down to 57, we're going to go in and buy. And there's tons more liquidity in the market, and you got to bring it back up to 60. And you're creating this resistance. And it's where that's going to hit. Is it going to be 70, 80, 90? I don't want to get too elaborate on this and, sound like 2021 all over again. But, it's a different time. It's a different time.
It's a very different time. Yeah, the sophistication of investors that we're talking to is, as I said at the earlier, it's a lot more institutional activity. The institutional, traditional, TradFi-esque due diligence processes, all of this scaffolding in and around investment decisions that people are making that they would make into a TradFi product that is being applied to the digital asset space, right? And it's the same bar. So, obviously there's some nuances with how assets are managed and things like that. Ultimately, it's the same bar, and there's some education here still to be done. There's, by no means do all these new entrants have all of the information to hand. So there's still a lot of opportunity here for educating. There's a need for that still. Again, you and I are in it a lot, so you kind of forget, you can sometimes forget this, but the education part is still very important, I think, in terms of how these assets work, custodized, managed, transferred, etc. So
tons. I know. I always kind of waver in between the, hey, we didn't need to know about how an HTML protocol really worked to be able to use a website, right? But if you were actually investing in a company back in the 1990s that was making websites better, you would do your due diligence into that. So I think it depends upon the amount of skin you have in the game on how deep you're going to go. If you're buying a Bitcoin ETF, you're probably not going to look to go read the Bitcoin white paper. Maybe you will, maybe you won't. I don't know. It's an investment product. But if you are investing in a company who's building a layer 2 on top of the Bitcoin blockchain, well, you sure as hell better know how it works, right? So I know that you had some ideas, Gray, around Bitcoin for long-term holding, and that we're seeing tons more activity out there on the Bitcoin blockchain in general. But how do you see these new innovations over the last year last year plus around the Bitcoin blockchain, and then the kind of growth of BTC as a long-term holding?
I think it depends. There's a couple of angles here. I think so from the holding around Bitcoin holders that have been around for a long time, and they are still, they're probably looking very smart at the moment in terms of their position that they've been holding over the N number of years. I guess what's starting to happen, certainly what we are seeing at Liquibit, and even just phone calls from mates, right? People who call you up because they know you're in crypto. What should I be doing? Should I be getting some Bitcoin now? The more sophisticated people are starting to say, okay, well, I have got some Bitcoin. I like it for long term now. How can I get some yield out of this? That's the key thing. I think the key part now is, okay, back to your point about floors. I feel that there's going to be some capital value in my asset for the long term that is going to continue to build and grow. How can I use that asset to start generating some yield? That's the first point. Funds like us, we have to respond to that demand and offer a yield product similar to our US dollar yielding arbitrage strategy. We can apply the same on Bitcoin subscriptions as well. And I think, again, back to that sort of risk reward, people are looking at, okay, I'm a long-term Bitcoin holder, but maybe I can put that to work in a way that, again, the risk reward profile is good. So I can start generating the 20% yield returns on my Bitcoin. Again, in the interest rate environment that we have at the moment, the risk-free rate is now up 5% or so, so the people are going to be looking to say, well, I've got Bitcoin, how can I generate some more attractive returns off of that? So that's point number one. I think point number two in terms of yield is that from a retail standpoint, there's more products out there that are available. Things, a lot of the exchanges are doing these earn type of things, again, in the environment where fiat has a high risk-free return rate at the moment. So there's a few options out there now for people to start saying, well, actually, I've got an asset that's worth something. I want to start sweating that asset. I can deploy it in a way that I start to feel comfortable. And the risk reward is there. And certainly the risk reward versus just holding, which traditionally was that, okay, I'm just going to hold. I'm going to get the capital appreciation. And I think as people start looking at the longer term view of the asset class, like, my analogy a little bit is like the housing markets. Back in the early 2000s, people got into property. They started to understand property they understand it as an asset, it's something I can feel, I can touch. And once they bought in, you saw a growth of new landlords who started to want to get yield on that asset. And it's a bit similar in some ways to Bitcoin, especially Bitcoin, I suppose. And it's an asset that people are starting to get more comfortable with, they can understand. And okay, now I'm in here for the long haul. I think the value of this thing is going to continue to appreciate. But I also want to get yield on it as well. So that's and a little bit, without getting too techie, the analysis we do in terms of generating yield on your Bitcoin through something like a market neutral strategy or something like that, where you're getting 15, 20% plus per year. If you look at the impact of that on your Sharpe ratio, the risk that measures the risk versus return profile on your Bitcoin, then you can start to insulate yourself a little bit from some of the price dips. And your Sharpe ratio can improve 30-35%. And so it's quite interesting to think about how yield also offers some buffer from some of the traditional volatility associated with these Bitcoin stuff. So
it does.
Yeah.
The real estate analogy is a really good one, where you start thinking about, listen, I'm going to sink a whole bunch of money into this property. I want to hold that for the long term. It's really hard to sell off a portion of it. I probably could do a deal, but I don't really want to. I've sunk some money into this. I want to hold it. But at the same time, I've got this asset and I want to earn something off of it now that I can take and I can use. So I have an apartment building. I can rent this out. I can rent these apartments out and I can generate yield off of that. I'm thinking about Bitcoin in the same way right now, is that I'm holding it for the long term. I've got a stash. That is what I've built up. Can I actually earn some yield off of this? And I think there's a big market for this. And it's one that's been developing a lot. And I've seen with the things like ordinals and runes and being able to actually pump more volume into the Bitcoin blockchain. That volume coming in, those transactions being secured, this is a massive global network of compute power. There's so many other uses for it. And it's always kind of paled in comparison, even though it's the OG, the Bitcoin blockchain, it's pale in comparison to the utility of Ethereum. And now I think a lot has kind of moved back into looking at the Bitcoin blockchain for what it really is and saying, there's a lot more that we can actually do with this. And I'm seeing stuff like BitVM that are doing some interesting things around smart contracts on the Bitcoin blockchain. And there's tons of potential there. I think that can be unlocked.
I mean, when you start talking about layer 1.5 or layer 2 around Bitcoin, it's extremely exciting in terms of it has sort of been that slow burn. It's always been in Ethereum's shadow in terms of the programmability over and above the asset that you get with smart contracts. I mean, I've always been a long supporter of stacks on a PA basis. The amount of economic activity in and around the Bitcoin ecosystem is extremely exciting. And I think, we're just still quite early with that. A lot of people don't even think of it like that in terms of the Bitcoin ecosystem. They just think Bitcoin, that's it, and anything else, okay, I switch over to Ethereum or Solana and I'm going to go elsewhere. But I think the understanding and the appreciation of what's going on over in and around the Bitcoin ecosystem, completely with you, Pete, it's growing. And again, if you've been in it for a while, you know it's there and you can see the value that it will bring. But I think the wider masses, there's going to be more publicity and more appreciation for what's going on. And ultimately, what is the asset class that also, it is the coin that everything is sort of pinned on still to some extent, right?
Where I'd like to see it go is that you get to the point where, fine, on my Coinbase app, you don't even have to think about it. You just know that you can stake your ETH, right? And you can earn some rewards off of that. And that it will get to the point where Bitcoin, you can just make that easy, same decision. There's going to be tons of things happening behind the scenes that the everyday user won't really be thinking about. But before we get there, there's going to be some, I'd say, bigger UX hurdles that we'll need to get over to make all of these types of things available to more sophisticated holders like we're talking about, those that are on the fringes of TradFi, perhaps trading in the hedge fund market for a while, comfortable with alternative assets, comfortable with having to do a few different things rather than what retail users do and the simplicity of a user experience that retail users have. And that because you have more skin in the game and more at stake here, no pun intended, that you are actually willing to do more of the work in order to put your assets to work. Just like that real estate property owner, that apartment building owner, that they're going to have to do more work to actually rent that apartment out and be a landlord. But you're willing to do that to get the yield.
Yeah,
and I think we're going to go through that type of period first before it just becomes, hey, an Airbnb experience. Just go rent your place. Easy user experience. Don't worry about it, right?
And I think the other thing that will help bridge the gap is wealth managers, structured products, things like that behind the scenes are wrapping up some of these return profiles based on the asset that you hold. We can drift into the tokenization conversation around tokenizing things like structured products, smart contracts that ultimately define how the structure, what the payoff's going to be. A lot of the wealth managers traditionally are very good at wrapping that up and selling that to a retail market as well. And that's the other angle where you're going to be able to start fill that gap because the UX isn't going to be there and the at least until the sort of the Gen Z or the Gen Alphas are of an age where they've got the capital to really throw around, which is going to be in a few years' time. There's going to be a bit of a gap there, and I think, but the wealth managers have a role to play in coming up with these products. We have to find a way to make it accessible and to get people to benefit, and the market will meet the demand. There's no question, right? We're already seeing it. So, we're not the only people offering, BTC yield products, right? There are other funds out there doing exactly the same thing, and this is all coming off the back of investor demand as people want to sweat these assets more for the long term because it's part of their portfolio, and that's the next step. So it's all pointing in the right direction, and it spurns the innovation. It spurns the innovation from the UX point of view. It spurns the innovation from smart contract development. It spurns the interaction with regulators because it's coming off the back of demand that TradFi has been dealing with and coming up with products for many years, and there's no different there for us.
Yeah, there's something interesting here that, like, I've been saying for a long time that I always say I've been saying it for a long time, but I'll just say it that the unique thing about crypto is that where the innovations are coming from are at the consumer level, because the consumer level is the user type, the demographic that has been driving crypto, because it's primarily been individuals and perhaps a level up from that who have been driving the market for, the last, at least for the first 10 years. And now we're at a point where, because it's entered into the upper echelons of institutional trading, that some of the same creative things that were happening in 2004, 2005 around credit default swaps, and we know what happened there, but that there was tons of investment banking level activity that was happening on, hey, you got 10 million to put into something. Let me give this really unique return pattern. Let's do some type of structured note. And what happened with Bitcoin with folks like Wisdom Tree in 2019, 2020 is that they started structuring notes around Bitcoin and started having these exchange traded notes. And they are obviously now one of the sponsors of the pure Bitcoin ETFs, the actual Bitcoin ETFs rather than exchange traded notes. So now that this type of asset class is mainstreaming, and I'll call it that we've got wily investment bankers who have been not sitting on the sidelines, but forced to only use traditional assets as their muse for some of their structured notes and products, that now they can do a lot more interesting things. And some of that may then drive how the consumer level around Bitcoin and around other crypto assets, how new innovations are then made available to them, right? In the same way that happened with traditional finance about 15, 20 years ago.
Yeah, I mean, it's sort of maybe been the tail wagging the dog for, like you say, for the first 10, 15 years in the industry. Maybe there's going to be a little bit more. So obviously, there's the level of sophistication comes into the industry, continues to increase.
Definitely.
One would almost expect the rate of innovation to accelerate. I mean, almost as bonkers as that sounds. Yeah, given the amount of innovation that generally is happening across the digital asset space, whether that's institutional, retail, crypto, tokenization, CBDC, whatever that is, right? It covers the broad spectrum here. We could probably see it increase further.
Yeah, I think we will. And speaking about mainstreaming, that stablecoins have also obviously a crypto asset themselves, but that when folks have conversations about crypto with those who are just even crypto curious or crypto haters, that most of them don't even know that stablecoins exist. And I recall a conversation between Charlie Munger, may he rest in peace, and I think it was John Collison from Stripe, where they were talking about Charlie's distaste for crypto. And John obviously is a fan of crypto. And we've seen that now with an announcement last week that Stripe are saying crypto is back. I'm like, you and I are saying it never went anywhere, right? Stripe are saying it's back for them and that this is all about stablecoins. But that conversation between John and Charlie, it was clear that Charlie had never heard of stablecoins. Right? He just didn't understand. And John was trying to bring that into the conversation, but Charlie just hadn't been aware of it. And out of respect for Charlie's position, which was, hey, if I don't understand it, I'm not going to invest in it, that John just took his foot off the gas with a conversation and, let's agree to disagree. Charlie said, hey, I'm good to go. Let's disagree. Let's just keep going. And he changed the subject. So the fact that stablecoins exist and that now even Visa, and they've been big proponents of this, big proponents of understanding, because they see that as a potential threat to their domain, that they've put up their stablecoin analytics dashboard that lets you look at all the different activity in the stablecoin market in the same way that you can do with Dune or Masari, but that it is more accessible to the masses in being able to understand that, probably more accessible to those in corporate innovation labs that are experimenting with financial products around stablecoins, right?
I think kudos to Visa because, they haven't stuck their head in the sand. They're not going to be the next blockbuster when it comes to payment rails. They understand what's going on in turn. One of the use cases for Bitcoin back in the day, I always remember saying, is that if you just look at the value transacted Bitcoin blockchain, look how much money is moving around the globe at speed and at low cost. And if you want any other reason for looking at this asset class, this is one reason. Just look, this value is being moved from A to B extremely quickly at extremely low cost. And obviously, stablecoins is the killer app. I think it's fantastic. The more on-off rails, great that Stripe have decided to go back in. Obviously, commercially, it's going to make sense for them. But they're flexible enough to say, we backed off. Now we're back in. Fantastic. Let's see more of that. The institutional on-off ramps. It's still not smooth. Stablecoins is very much the sort of the entry point for fiat money into the sort of the digital asset ecosystem that is running on blockchains. It's still bitty. Right? You've got fiat banks, you've got stablecoin minters. It's still a bit bitty. It's not cohesive. The UX, as you touched on it earlier, still clunky. People like Stripe who do specialize in, I think, do a pretty good job on UX when it comes to payments. I use them for our chalet rental thing that we do, and I use Stripe as a small business on that, and it's generally a pretty good platform. I think it's easy to use. Anything that they can bring into the stablecoin market that helps adoption, helps education, it's a great way of moving money. Let's be frank. And the level of, as the understanding of the product exists, again, it's a trust thing as well to some extent. When you think about USDC, I don't think you and I would ever have any concerns about shifting USDC around. And
no.
Circle have done a really good job of their sort of cross-chain protocol thing that they've got up and running. That's a thing now. It's got a label. It's got an acronym. So we think about a lot of it can be confusing when you think about stablecoins all across all different chains. And they're trying to address that as well. From our point of view, I think, certainly from my point of view, it's the killer app. It's still not completely solved. We haven't completed stablecoins and we can move on to the next thing. There's still more work. There's still more work
Lots
to
of
do.
work to do.
But it's really encouraging for things like Stripe and Visa, and it's just going to go from here. It's fantastic.
Absolutely. And the volume has been interesting. And I'll come back to that. But it was that on Tether USDC, which is Circle, and then DAI from Maker, the total for the three was $1.369 trillion in the first 3 months of the year. Compare that to the $1.23 trillion of volume on Visa. So we're at that level with stablecoin settlements. There's tons of things that happen in the stablecoin market that are probably inflating those numbers. Tons of things that happen in the crypto markets that are perhaps inflating those numbers a bit, or that maybe not inflating, but that it's understanding the difference between a retail consumer or a commercial transaction running over the Visa network versus a very popular asset to use when you're trading in DeFi, and where it may not be it's just a utility asset rather than it being actual indicative of a commercial activity. So there's tons that goes through there, but it's still an impressive volume number.
Yeah, and it's been supported on public blockchains. It's not one company that are responsible for maintaining, running all of these rails. It's run on public blockchains. You think about it from that lens, and it's really very impressive what's been built and how this amount of value is running every day seamlessly. Yeah, as I said, I think for on-ramp, off-ramp, or as a payment rail, we're used to Swift back in our old days.
Oh, yeah. But yeah, so those payment rails are like you mentioned, I think that's what's getting really interesting as well, in that with the unlock of Bitcoin as an asset that can be packaged up into an ETF, that came from a regulatory decision from the SEC. We need some type of stablecoin framework here. It's already happening in Europe with Mika. When I say here, I mean the US. I'm not there. I haven't been there since Christmas, but in the US, we need some stablecoin frameworks there, because what has made asset managers, wealth managers comfortable with a Bitcoin ETF so far in the first, 4 months of their existence is the fact that it is the ETFs themselves are a regulated product. Stablecoins, Circle themselves, very much operate like an electronic money institution in Europe, an EMI.
Yeah.
Okay. Safeguarding assets. There needs to be a 1-for-1. You pay in cash. You need to have an asset that backs that up. Now, on electronic money institution regulation in Europe, it needs to be cash for cash. You accept customer funds in fiat. You need to show that amount. If it's being represented in your crypto wallet as fiat, that fiat needs to be in a safeguarding account, named as a safeguarding account at a bank. Okay. So the regulation around that does not exist in the US for Circle. I think they would have liked to have applied, and maybe they have applied in the past for a banking license. But I think with Stripe now entering the game with USDC payments and the rails and pay in and pay out, I expect that they have money transmitter licenses in the US. And I heard recently that there is another attempt to bring a stablecoin bill through Congress. So if they can get to that level of regulation where that bell curve on the right-hand side of TradFi, of those that have become at least aware of this, mindful of this, looking at the innovation of stablecoins, that they can start to adopt the usage of that. Again, I think we're going to need some type of regulatory footing here for wider adoption to take place. The numbers so far have been really impressive compared to Visa, but we still know that this is just a drop in the bucket. If it's at Visa level at this point, without the regulatory backing, man, where's it going to get to?
Even if you strip out the noise as well, I think, the trajectory is the right path, and utility will lead the charge, I think. As you say, the more appreciation gets on as a way of interacting with anything digital asset wise, just in terms of exchanging for other digital assets, as tokenization and other products are digitized and put onto chains for transaction and value exchange, then of course, that's going to drive the adoption of stablecoins. Because what's not going to change anytime soon is people's perception of value in fiat currency terms. Okay, the diehards will consider perhaps, what is their net worth in terms of the amount of Bitcoin I have. But obviously the majority of this isn't going to change anytime soon. So it is going to be stablecoin growth is very north of here. Very north of here, and probably relatively, it'll still be a slow burn, I think. There's still more innovation. As I said, there's still a lot of work to do in terms of, I think, the stablecoin market. But it's all encouraging, it's heading in that direction. And I think, echo your point of regulation, if that framework starts to happen in the US around greenback equivalents, then happy days.
Yeah, and it's crazy. I'm just thinking that, both you and I left the traditional finance world to go pursue this crypto thing, right? And now it's starting to all come back together.
Look, I mean, the fact that we're still here, having been through the number of bear cycles that we have been, I think shows our belief in the asset class. You and I are singing to the choir here, but both from a technology innovation, utility, innovation in terms of product that you can deliver with this tech. All of these reasons that we got into it in the first place still exist, and we're going to continue to build on that. I think that's the exciting thing. And there's just, the market now, the addressable market size of these products is just growing. As the regulation comes in to support it, as education is there, our addressable market, Pete, for the products that you and I care about is just growing, both, whether it's from Liquibit standpoint or whether it's from the accelerator stuff that you do. All of this stuff, it's growing. It's going to continue to grow. So it's fantastic.
I'm glad I'm in early with skin in the game. That's all I got to say.
We're off zero.
We're off zero. Absolutely. Well, listen, Gray, it's been a fantastic chat. Really appreciate you coming back on the show to share this all with me. Good luck on the next big cycling expedition and keep it real.
Pete, wonderful to see you again. Thanks very much for having me on the show. It's always a pleasure to talk. And catch you around.
All right. That does it for this week, folks. And thanks to Gray Webb for all the insights he shared in co-hosting this episode with me. You can learn more about the stories we covered in the show notes on our website, moneyneversleeps.ie. And that's where you can also listen to all of our podcast episodes, or you can check out the back catalog on your favorite podcast player. Finally, till next time, thanks for listening. See ya.